Welcome to the Lazy CEO Podcast, where Jim Schleckser, author of Great CEOs Are Lazy and founder of the CEO Project, features compelling experts and topics for CEOs of mid to large-size companies. Now, let's get started with the show.
Welcome, everybody, to another Lazy CEO podcast. My name is Jim Schleckser. I am your host, and I am the founder of the CEO Project. Well, hey, inevitably, or maybe not always, but much of the time, entrepreneurs get to the place that they contemplate selling their company. And look, for most of us, this is probably the largest singular asset in our entire portfolio. It kind of dominates the entire equation. So sometimes this is because I'm just tired of doing what I'm doing, or the market is great, or, I just want to de-risk my life a little bit when 97% of my wealth is tied up in one asset class. Now, I've written before that you really shouldn't think about this as selling your business. What you're really doing is you're trading asset classes. In other words, I'm trading ownership in that entity for ownership in some other asset. Bonds, real estate, stock, whatever. And so when you think about these transactions, just think about it's not actually a sale, it's a trade. Now it goes your company to cash to another asset is sort of the vehicle that goes through to get to the other asset, unless you trade it directly. But you're really just trading assets. You got to be clear that I want to do that. I'll give you an example. There are some businesses that have significant cash flow. A lot of professional services firms look like this, for example, and yet nobody would pay you enough for that company to replace the cash flow if I was to put it in bonds or stocks or anything else. And so you have to really be ready to sell. And it's not just a financial transaction, because unless you really crush it and get an amazing price for it, likely the asset that you replace your business with won't have the cash flow of the business you just sold. So just think about that as you go into this line of consideration of should I sell my business or not. But what I want to talk about today are the things that you need to begin to do and think about prior to selling your company. So you don't just one day wake up and go, you know what, I think I'm going to sell my company today. Well, you could, but you're not going to get a great result because you will have not done all the groundwork, the spade work that's required to prepare yourself to get an optimal outcome in terms of financial return, your lifestyle, and other factors. So let's talk about what that means. Now, this preparation can start 2 to 3 years, sometimes even longer, before you're ready to sell the company. I've seen some people that start elements of this even longer than 2 to 3 years before they're ready to sell. But round numbers, that's enough that you should be in pretty good shape. So the first one is your team. So you want to make sure you have a quality executive team. They're doing their jobs. Ideally, interestingly enough, they are also protected, meaning the kind of contracts we like to see people put in place are separation agreements that come into effect upon a change in control, which basically says if I sell the company, you get a severance if the buyer chooses not to keep you around. Now, that's important because one of the things that a buyer is going to look at is, are you delivering me an intact management team? In other words, are all the people I need to run the business going to be there when I take over the business? Sometimes that doesn't happen because they get spooked at the new buyer, or they're worried about their future, or they don't think they're going to last. Putting the severance arrangement in place like that gives them confidence to say, hey, I'll go try out this new buyer and let's see what happens. Maybe it'll be great. Maybe it won't. And if it's not great, they're going to pay me to leave. So that it's a great way to sort of secure a management team. The beautiful thing about that move is that you don't pay it. In other words, the severance is paid by the buyer after they make a decision of whether they want to keep the person or not. But you're basically giving them discretion to keep that individual or not after the transaction. And so you've delivered the intact management team. But the other thing that's important within team is your role. So if you are critical to the business, top salesperson, top engineer, top marketer, top whatever thing you do that makes you critical to that business, like involved every day, the hiring of a team so that is not true is really, really critical. In other words, by the time you're ready to fully sell the business, you need to almost make yourself irrelevant. Maybe not fully irrelevant, but mostly, largely, significantly irrelevant. Because if you are critical to the business, in other words, you're still adding immense value on a daily basis, which, we all want to do, obviously, but you are not going to be able to get the check and leave the business. Any buyer worth their salt will figure out very quickly that you are critical to the business. And they're going to say, look, I'm happy to buy it, but you got to stick around for a year, 2 years, 3 years. So if your intention is sell and exit, you must have a management team in place that basically runs the business on a daily basis, and your involvement is no longer critical to the daily operation of the business. Now, here's where this shows up. Inevitably, when you sell the business, there is a time that you do management presentations. So the buyers looked over the numbers. They've indicated they're interested. They go, we'd like to learn more about the business. We've got questions. We'd like to get in front of the management team and ask our questions. So you're in the meeting room. The buyer is there. Your team is there. You're there. You've got to look at who answers the questions. And the buyer will be looking at this very, very closely. So if they go, well, what about, revenue over the last 2 years? And you jump in and answer the question, or help us understand your product roadmap, and you jump in and you answer those questions, guess what? They will very quickly figure out that you are critical to the business. You're running the business on a daily basis and you can't leave. Now, on the other hand, imagine they ask a question about product roadmap and you go, hey, Sally's my VP of HR, of engineering. Sally, why don't you take that one? And Sally does a great job, right? She runs through it, explains it, detail, organized, good to go. She's clearly on top of it. What's been happening to gross margin over the last 3 years? You go, hey, Mario's my CFO. Mario, why don't you explain what's going on? And you say almost nothing. Maybe you introduce some people or whatever, but you are obvious that the team owns all the responsibility. Then when you say, by the way, I don't want to be around after the transaction or after a very brief period of transition, they go, yeah, sounds about right to us. You got a great team here. The other thing to realize is that investors invest in teams. They like businesses, but they really like teams. So the caliber of the team, the quality of the people you have around the business is an investable asset. So the better they are, the more likely you can leave, the more likely you get a better price, the more likely that price stands up. And so it's just a good move. And that may mean, relative to your historic investment in your executive team, that you might pay more, right? So we've talked before about A players and that you probably pay kind of on average 20% more money for A players, but their impact is 70 to 100% higher, depending on role, than a B player. And so this is a case where it's time to spend the money to get A players in these critical roles so that you can exit the business when the time comes. The next one is financials. So a lot of us run through, we got QuickBooks. We've got, my sister-in-law's cousin who's running my books for me, maybe a little better than that, but they're not reviewed by a third party and they're not audited. Now, think about it from a buyer's point of view. To the extent that those financials have not been reviewed or audited, they can do due diligence and see if there's a skunk in the woodpile, if there's a problem with those financials. But ideally, you hand them audited or reviewed, which is a lower standard, financials, because that gives them comfort that the numbers are what the numbers are. If you don't have that, they're going to be asking themselves the question, I sure hope the numbers are right. Do we know they're right? No, we're not certain. We've checked them and we think we looked them over, but we're not sure about that. And so what do? To compensate for that higher risk? They pay you less money. They have to, right? They have to make up for the risk somehow. And that's in a slightly reduced price because they're not sure about the figures. So I would say, again, in that 2 to 3 year time frame, if you're not doing it already, to have your financials reviewed or even audited is a wise investment of money that will show up in the value you get at the end of the story. Those of us that have debt on our business, we already do this because that's a requirement of the bank. So that's kind of the good news about having a bank. They will have already asked you for this and you'll be accustomed to having reviewed or audited financials. I think that the fourth item is you need to start thinking about the sizzle on the steak. So, people love good businesses. They're making money, they're growing a little bit, they're profitable, they got high degrees of recurring revenue, they're low asset intensity, all the things that we like about businesses, investors tend to like about them. But you have to engineer it so that there is potential for the next owner. If you show a business where you've really tapped the market, you've done a great job of it, you've got great market share and wallet share within your client base, your margins have been sort of optimized, they go, great business, but what's in it for me besides owning it? How do I get my gain out of this business? What's the next thing that's going to happen that's going to cause it to grow or its margin to expand or profit to expand? And so you need to leave some on the table for the next buyer. In other words, hey, we've just opened up Europe. We've got some great early indications in Europe. It's now break even. We see a lot of upside in Europe going forward. Now, hopefully you'll get that in your price. And I want to talk about that in a minute, but people want to buy upside and an opportunity for upside. So if you don't show them upside, you won't get the same multiple that you would if there is an upside available. Now, you got to be a little bit careful about this because this is where the hockey stick, forecasts come out. We go, I've been growing 5% a year for the last 5 years and blah, blah, blah. But you know what? The second you buy it, it's going to 20% a year and it's going to grow ad infinitum until it's $100 million or $200 million company. I've had people present those forecasts to me before and I go, you shouldn't sell it. Why would you sell it if you know you've got 20% growth as far as the eye can see? You should hang on, grow it a couple of years, call me back, and then you sell it to me for a heck of a lot more money. And that's when you find out the 20% may not be as real as they'd like to imagine it is. But you do need some sizzle. So yes, sizzle, but not hockey stick sizzle. Some sizzle, not stupid amounts of sizzle that is not sustainable or supportable, or history doesn't support it. What you'll find is if you're optimistic in that way about the business, and yet the historic business didn't show that, this is where you end up in an earnout, right? So if, based on historic, I might pay $10 million for your business, but based on all that sizzle that you've loaded onto it, might be worth $20 million. Again, I'm making up these numbers. As a seller, you go, great, give me the $20 million because look at all that wonderful opportunity you've got. As a buyer, they go, look, all you're giving me is potential. You're not giving me real money. So what I'll do is I'll pay you 10 because that's what the business is worth today. And depending on how much of that wonderful opportunity truly happens in the next year, 2 years, whatever, I'll pay you a percentage of it. Obviously, I'm doing all the work, so you don't get as much as you would if you owned it, but you'll get some percentage of that gain. And there's why you end up in an earnout, because there's a differential view on the value of the business, and they solve it with an earnout. Now, Jim hates earnouts, and we can get into that on another show, but that's why you'll end up in an earnout. That has implications for you hanging around as well, which I might as well deal with it now. So, again, we talked about get the check and retire to the warm island or your cabin in the woods or wherever you want to go. And that's the mental model that a lot of people enter this conversation with. But if there is an earnout, most particularly if there's an earnout, or you've demonstrated that you're critical to the business, as I talked about before, they're going to want to have you hang around. In other words, they'll hand you a check, maybe a big check or part of the big check. And they go, look, we'd like you to hang around for a couple of years and make sure we deliver on this amazing plan you put in front of us. And then you're stuck for a year, 2 years, 3 years. Now, I'll tell you, as entrepreneurs, it is rare that we last in those environments. Once in a while, yep, it happens. But more often than not, the entrepreneur is out of that business within a year. So just realize that when you're talking about an earnout, that the probability you're going to see your way to the end of a 2 or 3 year earnout is unlikely. And then you are placing your future financial payment in the hands of other people. And, that may be okay, but it does increase your risk of getting that payout. Sometimes you get it, sometimes you don't. So just realize that you will likely not last because entrepreneurs are not used to dealing with corporate baloney, and you'll have a lot of corporate baloney depending on who the owner is. And then somebody else is going to be responsible for delivering your earnout, and they don't have the interest in it that you do, so you likely won't get everything. So just realize that may be coming as well. I talked about the executive team. but there's also a team of professionals that you need to put around yourself. This is a little, you could start as early as 2 or 3 years. Generally, it's a little closer to a potential sale date. But the first is you need an attorney. Now, I want to be clear. I've written articles about this. You need the right kind of attorney. An attorney is not an attorney is not an attorney. If I've got a problem with my feet, I don't go to a cardiologist. If I've got a problem with my brain, I don't go to a gastroenterologist. Same thing's true for attorneys. They specialize. And so I had one transaction that a client of ours was involved in. The seller had a buddy who was a patent attorney, fabulous profession, and he was having him do a corporate transaction, an M&A deal. Well, M&A law is a specialized field. And so when you're looking for an attorney, you may look at your current attorney. Odds are they will not have the expertise to do a good job of an M&A deal, of a purchase of your company. So you're going to want to find somebody who has expertise in that particular field. You'll be better. So even if they cost more money, they'll pay for themselves. So you need an attorney that understands the space. The second is you need an accountant. Now, you might need two accountants here. One is the person that, as I said, reviewing your books or auditing your books, because the buyer is going to want to talk to that accountant to say, run us through the books, help us understand what principles did you use? How did you deal with accruals? How did you account for capital? How did you deal with R&D? Did you capitalize it? 100 questions around the financials. So you need a quality person there. CFO is great. And in a larger company, your CFO will be able to handle that. In a smaller company, you need an external, highly qualified CPA kind of accountant. Now, the other issue, though, is structuring the deal in a way that it is tax efficient. Now, sometimes that happens intrinsically, and I'll get into this in a minute. Depending on the way that the sale is structured, it could be capital gains, which is ideal for you. But a tax attorney, and maybe even a tax lawyer, if it's a big deal, can help you with how do we set up the ownership? How do we move the money around in the most tax efficient way? Let me give you an example. Let's say it's a profound sale, $100 million. You might say, look, I don't need $100 million in my life. I can live my life, buy the houses I want, live whatever way I want for a lot less than that. But I'm going to die someday, probably. And I wouldn't mind giving my kids some money. It is an interesting opportunity to transfer money into, for example, a trust for them before the sale. This is why we're talking about 2 or 3 years before, so that the money pipes into a trust for my kids. I never take it as income, Now, that's the kind of thing that a tax accountant or a tax lawyer can help you with. It helps your family out. It positions the wealth where you want it. And, operators and business owners like us don't think like that. It is the life, it's the career of this kind of specialized individual to think like that. So maybe two accountants, one that's tax focused and one that's book focused. And then I would recommend a third individual on your team. And most people don't think about this. Let me go back. There's four. The third one is a banker. So this is somebody who understands your space. Ideally, they've done deals in your space, hopefully lots and lots and lots of them. And they can help you do this sale. Now, you need a banker because, look, it's the largest transaction you're ever going to do in your life. You've never done it before, probably. And it's really easy to screw it up. A banker lives and breathes this stuff. And their job is to find the buyers, help them through the process, and get the sale done. Now, all bankers look, in Jim's opinion, all bankers look the same. They all went to Harvard. They all have fancy suits and pretty haircuts, and they use big words and blah, blah, blah. And they're all elegant human beings. So how do you decide, right? People talk about having a beauty contest, and they all do great PowerPoint presentations, and they speak well, and they talk about the deals they were involved. How do you decide? And my answer is, it is all about who they know. It is all about their access and their volume in the space. And so I'd spend a lot of time on, where do your connections go to? How many of the people that are likely buyers do you know? How many have you done deals with before? Because you want somebody who can pick up the phone and call the CEO of a likely buyer and say, hey, Juan, I've got a deal for you. Do you know, it's the company's in Maryland. It looks like this, it looks like that. odds are he's going to guess who it is, but we're not giving the name at this point. And he can make that call directly, as opposed to sending in a blind prospectus, hoping somebody picks it up, hoping somebody finds interest with it. Anybody can do that, and it's not interesting. It's the ability to make personal connections to the people that are critical that differentiates the banker you want versus the banker you don't want. And again, the key marker there is volume of transactions in your market. That's the key marker. And for me, that tends to skew me towards boutiques, although sometimes in larger firms, they specialize in a particular area. So banker you need. But let me just be clear. Your interests are not aligned with your banker. Let me say that again. Your interests and the interests of the bankers are not aligned. So one way to think about this is like a real estate agent. Same deal. Your interests and the interests of the real estate agent are not fully aligned. They want to get a sale done. You want to get a sale done. They want to make sure your house looks nice. They do the same thing. But what if, in order to get the deal done, you've got to cut the price $100,000? You're not really interested in doing that. But the real estate agent, because they're only making a small percentage, and interesting enough, that may even be shrinking based on a recent case law, they make a relatively small percentage on that $100,000 reduction. And so they're fine with a $100,000 reduction in sale price because it's going to cost them $6,000, and probably to an individual real estate agent, a lot less than $6,000. So the choice is get the sale done at a little bit less money, or don't get the sale done. I'm going to try to convince you to cut the price by $100,000 to get the deal done. Same exact thing is true for your banker. They get paid on success. So if that means that you get 97 million instead of 105 million, honestly, they don't care because it doesn't change their fee at all. Well, it does a little bit, but very, very little in the scheme of things. And so they'll be pressing you to take and settle for a deal that may not be optimal for you, either on terms or on price. And so in that way, your interests are not fully aligned with your banker, and you just need to be aware of that. They will never tell you this, but I'm going to say this is an issue you're going to have to deal with. So that is where we come up with the fourth person that's on the team. This is somebody that most people don't put on the team, but we've performed this function for a number of our clients as they've sold their business. There are other people that'll do it, and that is a commercial advisor. So commercial advisory is really important because the accountant has a view. That's the legal risk management. The attorney has a view, legal risk management. The accountant has a view, the numbers and the tax efficiency. The banker has a view, which is let's get the deal done. But who is protecting your commercial interests in this deal? In other words, a lawyer will try to drive all the risk out of a deal, but sometimes irrationally so. And somebody has to be able to help you to say, we can accept that risk. We don't accept that one. This one doesn't matter. This one's really important. And help you engineer a transaction that meets your personal obligations and needs in the business. And that is a commercial advisor, somebody who's done lots and lots of deals. They understand where the critical factors are. They can help you avoid the ones that really matter or that don't matter and deal appropriately with the ones that matter. And again, the banker won't do that because they want you to just sign the deal. The lawyer will drive all risk to zero, and that's not commercially viable. And so who splits the difference? You'll end up having to do it, but you've never done it before. And that's why you need somebody who's a commercial advisor. Again, this is not normally a name people put on this list, but our recommendation is it may be the most important one in successfully executing a deal. So that's the team. And you could start getting to know these people now, even though there's no deal to be had. The smart bankers, lawyers, accountants know that, hey, it is likely there's a transaction here in the future. And if I build a relationship, I am likely the person to be called. So I'm game to do that. So let's talk for a second about your salary. So this is the next item. Many times as owners and entrepreneurs, we take a modest salary, frankly, below market. You go, I paid myself that for a long time. I don't need more. I just take it out in dividends. It all works out. And oh, by the way, I make my profit look better when my salary is lower. And the mental model is the higher the profit, you multiply by whatever multiple, 3, 4, 7, 10, whatever it is. So the more profit I show, the higher a price I'm going to get. Problem is you're wrong. Any buyer worth their salt is going to see through that. They'll see that you're under market. And what they will do is they will adjust the profit downward for the price they're going to have to pay for a real CEO. And so you're going to end up getting the profit reduced by up to a market level CEO compensation, no matter what. So my answer is you might as well pay yourself that amount of money. And so this model of, oh, I'll pay myself less and show profit higher doesn't work, because that will be adjusted in the transaction process. So pay yourself what you're worth, pay yourself what market is, and because it's not going to ultimately affect your price one way or the other. Quickly, assets, particularly ones that can get old and stinky, like inventory, need to be clean. So if you've been holding off taking your medicine and cleaning out your inventory, taking the write down, my recommendation is just get that done now, because a quality buyer will assess your inventory, will look at slow moving, and they will adjust your balance sheet based on it. You might as well do it ahead of time. And there's a certain comfort for a buyer if they're not the one finding these things. They find that you've already done the work and you've cleaned it out. It gives them comfort that the rest of the numbers are clean. So clean up your assets. Your balance sheet should be a nice, tight, clean balance sheet. If there's old, stinky stuff like a payable that's sitting there for a year and you haven't collected it, but you know the guy and he probably ought to pay, just write it off. If it ever shows up, it shows up. Couple of smaller items here. Contracts. Again, this is a reason to start 2 or 3 years ahead. One of the key contractual elements that everybody ignores if they've never done a sale of a company before is the assignability of that contract. So what do I mean when I say that? In the contract, it'll say either you can assign this contract at will or something along those lines, or you cannot assign this contract unless we give you approval to do so. So what that means is, let's say I sell the company and I'm going to assign all my contracts to the new buyer, right? My landlord can hold up the deal. They can say, yeah, I'm not going to let you sign the contract, or they use it as an opportunity to renegotiate the price of their lease in the middle of the transaction, right? So you need to be very careful about that. Ideally, you have, will not unreasonably withheld, or, they will grant in a certain number of days, so they can't hold you up too long, but you need more expansive language around the assignability of contracts. So that when it comes to transaction time and you're assigning contracts, you don't have a problem on your hands. I'll give you a stupid, silly, quick example. We had a piece of freeware, it was free, that we used to manage some storage devices in one of the companies that I ran. And the lawyers on the other side were all over the assignability of this contract, of this free piece of software. And finally, after literally thousands of dollars of legal costs on both sides, I said, tell you what I'm going to do. 12 seconds before we do the transaction, I will take that software off of my servers, so it's not existing at the time of close. And 12 seconds after we close, I will download it again for free and we'll begin to use it again. And they go, oh, well, that's a perfect answer. I'm like, oh my gosh, I can't believe we had this conversation. So that was around assignability, and it just got silly. So ideally, you can get assignability clauses in most of your important contracts. Obviously, customer relations need to be positive, and ideally, you don't have a giant customer concentration. If you're concentrated, meaning, let's say over 10 or 15% of your revenue comes from one client, or even profit concentration comes from one client, you need to work to try to mitigate that a bit. I've dealt with clients that have 60, 70% of their revenue coming from large clients like an Amazon or a Walmart. And, good news is I've got Walmart. Bad news is I've got Walmart and I'm concentrated as heck right now. That's viewed as risk, because if you lost that client, the business completely changes. And so to the extent you can, this is again 2 to 3 years ahead, you've got to manage down that revenue by diluting it, ideally with new clients that are not Amazon, Walmart, or whoever your giant client is. So concentration is a big red flag for a buyer. Get to work on it now. And, right now you might be comfortable, but they will not be. And so you need to deal with it ahead of time. And then finally, just realize you're going into a process. It's going to be super distracting for you and your team. So trying to continue to deliver financial results while you're managing a sale process is painful. And then just one last thought on, and that'll be run largely by your banker, but remember, there'll be management meetings, there'll be information requests, there'll be due diligence requests, particularly your CFO and their team will be busy as you go through this process. When you're thinking about this, though, in terms of the sale, and I'll end on this topic, be open to who that buyer might be. We normally walk around, people will ask, oh, who's your likely buyer? Oh, it's so-and-so, or it's this other company. You got to be open to the idea that it may not be them. It may be somebody else. And everybody talks about wanting a strategic buyer because we think strategic buyers pay the most money because it solves like multiple problems for them. It's not just a financial buy. It's a strategic buy. So it's financial plus like upside opportunity. Many times you're right. It's not always true, but many times you're right. It turns out that the financial buyers have become quite aggressive. Today's environment's a little bit different than it was a year ago, but generally they become quite aggressive in being willing to pay up to buy companies. Why? Because there's not that many quality companies out there, and money has flown into private equity by the truckload. And so they've got millions and billions of dollars that they have to spend to keep their phony baloney jobs. And that means they need to find a company to buy. And so if that means they got to pay up a little bit to get those companies, they're going to do it. And so just be open to the idea. It might be a financial buyer or a strategic buyer or somebody you don't even know. Now, most of the times when I sold a company, I handed the banker the list of the likely buyers, and then they would expand on that a bit. And almost all the time it came from one of the names on my list. So you probably know who your likely buyers are, and you're going to be handing that to the banker and letting them do their job based on that. So, but just be open to that. You might be wrong, and it could be somebody you didn't expect that wants to get into this market or wants your product line or wants your people or whatever they might want. So I know that was a lot of stuff. This is a complicated process. This is just the getting ready. I haven't even gotten into the sale process, which maybe I'll do on a future Lazy CEO podcast, but there is a lot to think about. And the earlier you get some of the people on your team around you that can help you think about it and prepare, I think the better off you are. You're likely to get a highly successful transaction, and you can solve your personal desire to either be involved or not be involved. So on that note, I'm going to end. I hope you got something out of this conversation, and I wish you very good luck in the future. We'll see you next time on the Lazy CEO podcast. Thanks a lot. This podcast is brought to you by the CEO Project. At the CEO Project, we work with CEOs to help them grow their business. And our members represent billions of dollars of revenue and profit. And frankly, amongst all of us, we've probably made every mistake in the book, including some you haven't made yet. So if you want to learn from the experience of a bunch of really seasoned CEOs, we're a great place to hang out. In this podcast, what you're going to hear are some of those ideas, concepts, and things that are just going to help you on your journey. If you want to find out more, reach out to us at theceoproject.com, or you can contact me personally at jim@theceoproject.com. Happy listening.
Thanks for listening to the Lazy CEO podcast. We'll see you next time, and be sure to click subscribe to get future episodes, and check out our website, www.theceoproject.com.